The following is a conversation with Harsh Chowdhary. Harsh is a seasoned trader and fund manager currently based in Dubai. His extensive background in Forex, commodities, and indices trading, and managing a substantial 200k proprietary account at FTMO Trading speaks volumes about his expertise. Beyond his professional achievements, Harsh is also passionate about mentoring aspiring traders and helping them navigate the complexities of the financial markets. And now, dear friends, here is Harsh Chowdhury.
So today on our fifth episode for TradePod, we have Harsh. Harsh is an incredible trader with an incredible amount of experience in the trading space. Harsh is a fund manager and a Forex and commodities trader for over a long period of time, and we're so glad to have you here, Harsh. So, yeah, Mike is yours. How are you today?
I'm good, great. Thanks, Afid, for calling me, and thanks, Alan, for being there with us. And I'm looking forward
Sure,
to it.
Alan is always
amazing.
with us. We're together. Yeah. Yeah, so first, we would like to thank you for being here, and I would like to remind each and every person that will listen to the podcast that our entire effort that we're investing within the episode is to provide with our audience with as much as value and to literally spread your message to the world to understand how we can as a traders to be better at what we do and how you can be better at what you do. This is a win-win, man. So without further ado, Harsh, please introduce yourself. Let the nation know who you are.
All
Nation of
right.
traders, nation of TradePod.
Perfect. So my name is Harsh. I'm basically from Dubai. All right. So I was born and brought up in India. I'm from Mumbai. All right. The Bollywood city of India. And for the past 20 years, I have been residing in UAE, Dubai. So basically, I've done my schooling in Dubai. And for the past 8 years, all right, past 8 years, I have been associated with the financial markets. So, like any person on this planet Earth, who was curious about what is trading about, how trading works, you might be knowing a freak, we all got carried away with all the Hollywood movies, where we have people walking in Armani suits and, looking at screens. And, there were kind of lines on the charts, on the monitors. And they were sitting in front of, a river of monitors. So that got my attention. And I was like, I want to, know, like, what is it about? So that is how I stumbled across, trading. And I knew I had to start from somewhere. But then I was like, okay, where should I start from? Should I start from Google? Should I start from YouTube? So my dad had told me, like, if you want to learn trading, you have to learn from the people who are in trading, who have been through trading. So that is
Wisdom,
where.
wisdom for father.
Yes. So that is how my trading journey started 8 years back. All right. So I have undertaken a lot of courses. I've taken courses from Online Trading Academy, which is basically based from USA. I have even learned from Learn to Trade. If you might be aware of Mr. Jordan Belfort from Wolf of Wall Street. Yeah.
For sure.
Of
Does it?
course.
So that
Big
Yeah.
has
fan of
been,
Jordan.
that
By
has
the way, he's
been,
gonna be he's gonna be the next guest of TradePod.
oh, interesting.
No, not really, not really.
Someday.
Just joking.
Someday.
So you know
Never
what I
say
wanted
never.
to, yeah, his very close friend. His name is Mr. Greg Secker. He is the owner of Loan to Trade from Australia. So I have even undertaken his seminars, his courses. So you get it, right? Like I had to start from somewhere, but I had to make sure that wherever I start or from whoever I learn has to be, thoroughly
What
experienced in
was
the
so
financial
unique within
markets.
what was so unique within this man, George, your first mentor? What have captured your eyes within like the understanding that all right, you're passionate about trading. By the way, I'll tell you something. When you get attracted to trading because of the money, in comparison, that you get the attraction for trading because of the charts and something within it excites you, it's much more better. Now, as you have already mentioned, you got the attraction from the charts itself and not the money that you can make out of it. So there is like a deep understanding that this is the thing that you want to be doing. So I guess that you have explored the market and you learn who is the best trading coach or who is the best, I don't know, trading teacher, so on. Um, what I wanted to ask you, I want to ask you what have catch your attention within George. What's his name again? I'm sorry, I couldn't catch it.
Greg Secker.
Greg Secco. I'm sorry. So what have catch your attention within Greg Secco, except from the others?
Uh, Greg Secker has been, it's not exactly Greg Secker who has been teaching, it's his associates, his colleagues, right? So they have been focused more on the technical aspect of aspect of trading, It's more about what you look at charts and how you can perceive, the information that is already mentioned on the charts. But before that, it's been more about, the lifestyle that he lives. Because, at the end, no matter whatever you do in life, the motivation for you has always been about money, right? So that is where he used to showcase about his lifestyle, living in the best mansions and, having the best cars, having his own aviation fleet of helicopters. So that is first that got my curiosity. Like, there is something out there that, people can trade and make that kind of money. Now, when it comes to the technicals, right, I'm more of a technical trader myself. So what I observed, from such people or such institutions such as Learn to Trade or Online Trading Academy, they have a very systematic approach to trading. They just don't dilly-dally, with drawing random lines, using indicators. There has to be a very clear and thorough understanding of how the financial markets work. What are the factors behind them? What motivates, what drives prices? So that is where, I started to understand, all right, it's not just about drawing random lines and charts and, expecting to take a trade and hope for the best. No, it all boils down to, understanding the basics, the fundamentals. It could be the economics, it could be what are the higher time frame charts showing everything, right? So there are a lot of factors that encompass everything, to kind of get to this level. So yeah.
I get it. And I would like to ask you something a lot more deeper within your approach and attribution about trading. When you're trading, by the way, the people that are going to be listening to the podcast won't see the recording itself because we're providing only with audio right now. But you have eight screens, guys, behind you.
7 actually.
And I would like to understand first how do you remain focused on trading and how you can measure or merge the entire I can't believe that each screen presents with another instrument. How you can merge your understanding to trading out of eight screens. How do you remain consistent with it?
All right. So to answer that question, it's important to understand that the screens you see at the back are, more of a tool which is used for analyzing the trades that are already running. I do not use all the eight all the time. You only require one or maximum two. So my main analysis takes place only on the main screen. And once I do my analysis and my due diligence, I place them on the screens behind me. So, I have eight, so I can place like eight running trades. So, I can have an overlook.
You're seeing the trade taking place live and you're not getting stressed. Like you're like making sure that everything works fine. I just want to understand because, when I trade and when I look at the graph and when I am insecure about the trade itself, when I look at the charts, I'm getting freaked out. I'm getting freaked out. No, I'm being that serious. I'm getting freaked out, and it happens so many times when I enter to the ES with five or six contracts in the same trade, and when I don't take care of for the trade, I'm like freaking out, and like I would like to know how would you maintain your focus entirely when you're trading?
All right. So Afiq, the main thing that is very important in trading is risk management. You cannot expect to take a trade and loiter around it. You cannot take unwanted stress, because if you're taking unwanted stress, it means you're risking too much on a particular trade. The main aspect of how trading works is it all boils down to risk management. No matter how many trades I have, which trades are running, which pairs, forex pairs, indices, futures, options, no matter whatever I'm trading, it all boils down to how much risk I am giving per trade, and I should not be attached to whether will that trade make me a winner or will that trade stop me out. It all, see, because trading is speculative, it is not a predicting game, it is a speculating game. You can only do your due diligence, and you can filter out, you can analyze, figure out your high probability trades. But at the end, the trade is going to do what it wants to do. You stressing over it, or you expecting that just because I'm putting too much of energy into it, or I'm putting too much of worry into it, that I should expect the trade to do what I want to, is not in your control. It's like, looking at the sky and expecting it to rain just because you want it to rain. It will rain when it
Mhm.
wants to rain, right? So what I mean to
Yeah,
say is you have to be very clear about your risk management protocols. And
and
once,
today, this morning we had a conversation with an Australian trader, and he told us that he has a game plan. And when you have a game plan, or according to your language, a protocol for risk management, you need to understand and to work under your protocols on the predetermined protocols, right? How would
right.
you determine? How would you first discover what protocols you need to have, and how do you manage your risk before the understanding of how do you actually need to manage your risk? Because if you don't know how to do it practically, you will never ever know how to do it like in the live market. So when you're in a trade, they're actually taking place right now.
Right.
So tell me, please.
So basically, first and foremost, you have to understand what product suits you well. There are unlimited number of products in the financial markets, right from forex, futures, options, and stocks. Now, personally, me, I have been more of a forex trader, because you get good leverage, you don't have unwanted margins, heavy margins, and it works for me pretty fine, whereas someone maybe in the USA and all, where the rules are more strict and they have to follow more compliancy, they have to be focusing more on futures or stocks. So similarly, once you decide that, all right, in my particular country, wherever I'm residing, whatever rules and regulations are to be followed, that is your main concern, so that you can, adapt to the markets that are being provided to you, rather than trying to break your head upon a product that is not under your control. And second, when it comes to risk management, it all boils down to, are you an aggressive, conservative, or a moderate, psychic trader, in terms of, all right, you think like, okay, I have a capital, for example, 1K, and I know that, all right, my strategy is kind of working well. I have high probability setups. I can risk 2%, maybe 3% per trade. So that is more of an aggressive trader. Me personally, I am more of a conservative trader, where I would personally risk not more than 1% per trade. And it all boils down because you have a large portfolio to handle. Trading is not about how you can flip accounts, from $1,000 account to $100,000 account. It's how you can manage $100,000 account and keep accumulating more funds, from
To
clients, from
save your
prop
capital.
firms. Exactly. So increase your capital, manage your risk, rather than going aggressive. And ultimately you might be making a couple of winners here and there, but it puts a lot of stress on the account. And more than the account, it puts stress over you, because You are in that process of
Exactly.
thinking, right? Yeah.
Exactly. So let me ask you this. When you Let me ask you this. I want you to outline the worst trade that you've ever had, and how would you learn how to risk your manage, how to manage your risk from there? Like,
All right.
how, in practical, what do you do? Let's hypothetically say that you have 200K K account, all right? Let's say with one of the prop firms out there. Let's
All right.
just not tell their name here. Um, how would you manage risk under under drawdowns? Like they have a predefined drawdown, max drawdown and daily drawdown that you can't breach unless you lose the challenge, which is pretty tight. And how would you do it properly? How would you manage your trade properly? And how can you drive it towards success? Because it's not just about flipping accounts, it's about making actually good in trading.
Exactly. So for that, all right, when it comes to risk management, some people, or I would say the commonality way of looking at it is through percentage wise, right? Like, all right, I'm trading, for example, a 200K account. So one person on a 200K account is $2,000, So you know what I'll do? I'll risk $2,000 per trade. So that's 1%. And I have five shots, like a revolver, right? I can shoot five times. Now, if I lose five times, I hit the daily drawdown limit, and it puts a lot of stress on me because now I'm left with only 50% of what I can play with. And then I'm having to put more stress over my trading skills and my psychic, and now I'm not in a good zone because I'm not comfortable. I'm not confident of my trades. Rather than that approach, I would say if you're handling, for example, like you said, if you're handling a $200,000 account, I would risk maybe 500 initially, or maybe 1000, reduce the risk, reduce, it puts less pressure for you to overperform. The moment you have this performance anxiety, you're like, all right, now I have to perform because I have to prove myself, I have to prove others that I can get this thing done. So first and foremost, the moment you start hitting a series of drawdowns or a series of stop losses, come on, the markets are going to do what they have to do, and no one is right 100%. You will have your streak of losers, losing trades. At that time, the most important thing is for you to not recover the funds. The most important thing is how you can save your capital, how you can play within the rules of whichever prop firm you are tied up to, and make sure that you do not hit those drawdown levels. So if you were risking, for example, 1%, cut it down to zero point 0.5. If you're risking zero point 0.5, cut it down to 0.25. Don't put unwanted stress. Yeah, there are people out there who are like, no, we will buy another account. Yeah, you can do that, but if you cannot sustain well on your current account, what do you expect? You cannot expect something different on another account. So it might take time, it might be tedious, it might take a lot of time and effort for you to get it back to break even, but it will save your soul, because if you can get it back to where it was before after your series of losses, there is no doubt that you can again apply, increase your portfolio. And there are many people out there, and some that I'm aware of, who are doing very well. So everyone has their ups and downs, but during these low phases, it's all about risk management and believing. If the trading strategy has proven success in the past, it can prove success in the future too. You might have to make a couple of tweaks here and there, but the game remains the same. It's all about probability and risk management.
I see. So, um, you know what? Let's take it. All right, I understand the part of risk management, but I want to understand right now, like you're trading Forex and you trade commodities. So in commodities and Forex trading, you have fundamentals. I would like to know what are your what is the fundamental incentive that you look at to understand the market sentiment, like in general. Like, do you look at the COT report? Do you look at the news? that coming up, what currency pairs you trade in general, what is important, what drives the market, like how do you approach fundamentals within trading? Because without knowing fundamentals, the market controls you. You don't
Exactly.
control the market.
Right.
And also, how do you structure all that data into a coherent decision
Okay.
within your
All
trading?
right. So
Great
fundamentally
topic.
based, yeah, fundamentally based, I am only looking at the COT report. And when people think about looking at the COT report, I don't, go to the CFTC website and I download everything and I make an Excel sheet. I don't do all that. But what I
I'll
do
just explain to
is,
the audience. I'll just explain to the audience. COT report is Commitment of Trader report, which outlines. Well, first of all, it comes out every single week. It been delivered from the CFTC, and it outlines the current state of the instrument. What there we have commercial, not commercial, and unrepresentative buying, and it really provides you with an understanding of what who took a place within the last week, and who enters the market. It really gives you an insight of understanding what's going to be next if you know how to read that, if you know how to read that contract properly. Don't take my word for it. Go explore it for yourself. And yeah, back to you, Harsh.
wow, that was a nice description. So yeah,
Thanks.
so I look at the COT report, but I don't look at the numbers by themselves. I look at the indicator, and there are tons of indicators
Bar
out
chart.
there. Bar charts are one of them. Even TradingView, for example, has a lot of people who develop, and they even give it for free. So sometimes you have free indicators too that work very well. So I look at the COT report indicator, all right, and over here, what I basically do is I try to look at the divergences between the commercials and the non-commercials. So
Really?
this, yes.
That's the point. Let's talk about this.
All right. So
Divergence. What the divergence means?
a divergence basically means when two things diverge, so they're far apart from each other. So, for example, if this is the commercials and these are the non-commercials, they generally diverge, like because the market is a zero-sum game. What goes
Yeah.
in goes out, right? And you already know that you and me are goldfishes in the ocean of trading, there are big whales, there are white sharks out there, which are the big banks, the big hedge funds, they are the ones who control the markets. You can only you can swim with them. You cannot swim against them, or you cannot beat them also. So how do you understand what are they doing in the markets? And for them, for you to understand what they do, the COT report indicator is a wonderful tool to use. So when you have certain divergence, when someone is heavily buying and the other counterparty is heavily selling, that shows that there might come a place in the future where prices might start to correct themselves. I'm not saying reverse, but I would say correct themselves. So a COT report, like you said, comes out once a week, right? So the data is published on Tuesday, or the report is outsourced on Tuesday. So it takes 1 week for one COT report. So I play with numbers, So I look at, maybe, for example, I would look at 52 weeks. So 52 weeks is, the yearly cycle. Or I would look at
Mm-hmm.
maybe 26 weeks. 26 is the 6 month
Half a year.
cycle.
Yeah.
Exactly. Or I would look at the 3 years, the 156 weeks, So 156 weeks is basically equivalent to 3 years. So these couple of, time
This is
frames
like
are enough.
higher time frame to lower time frame. Exactly.
Exactly, right?
How
So
do you manage your understanding from each time frame? Because you spoke about the 3 years, the 1 year, and the three and
six
the half a
months,
year. Yeah.
right?
So how do you manage your understanding from 3 years? All right, that's a big amount of data. This is less accurate. Year, it's like in the middle, and 6 months back, that could give you a much more proper understanding.
Exactly.
Now, that's a story behind it. That's a story that you need to understand. That's a story that you need to build up to yourself in order to understand what's the next move of the commercial and the non-commercials who are involved in the COT report. What do you do?
Exactly.
How do you build up a story? How do you enable yourself to understand what's the next step?
All right. So like you said, I've given you three time frames. One is the 6 months, one is the 1 year, and the other one is the 3 years. So 3 years is long term, it takes a lot of time for them to diverge at that time frame, at that duration. But when it comes to 6 months, 6 months, it's more like kind of a trade which can, work out for a couple of days. So it's more recurring, because when you look at the indicator on the 6 months, they are diverging almost every second or third week. So you get regular trades on the 6 months. The 1 year acts as a buffer because it's double of the 6 months, right? So it kind of gives you a little buffer. So whenever these two indicators are diverged together, the 6 months is also showing the same picture, and the one
So
year
it's
is
like
also
a
showing.
congruence between the time frames. It's a
Exactly, yeah,
congruence.
congruence.
You
Right.
you, you need to have, yeah, congruency between the time frames in order to understand and build up a story.
Exactly. Trading is more about congruence, because you can't just go with one confirmation that, you might expect this or that. The more the confirmations, the more the confluences, the higher the probability, right? So that is
Mhm.
how it helps. So yeah, so COT report is the basic fundamental tool that I use to evaluate, the Forex pairs at a fundamental level. Then it's all about charts, looking at what the charts are talking, what are they showing, what am I expecting, and those kind of things. Yeah.
Really. And how do you, all right, if the COT is the only thing that you look at in the divergence and how you build the story, now I'd like to, let's, what currency pair do you like to trade the most?
I don't
Let's
have a
understand how
favorite
do you
pair.
build a story? How do you look at a COT deeper? Let's
All
dive
right,
deeper. All right.
cool.
So, what is your preferred currency pair nowadays?
Uh, Euro dollar. Yeah, that's the most basic pair. Yeah.
Ah, what a surprise. I couldn't guess better. So let's go and over the COT data for the last 3 years, 1 year and a half, a year that you remember, and I can self-assure to myself that you remember what happened during this time. Please tell me, how do you plan a story, or how do you build up a story to understand the fundamentals of the last 3 years of the euro dollar?
Okay, so as far as what I remember for the euro dollar, I started to see a formation, a divergence formation on the fundamentals, right? I'm talking about the COT indicator on trading view. So I started to observe, all right, the charts are diverging, on the 6 months and on the 1 year and even on the 3 years. So now this starts to give you an indication that maybe, in the coming days,
When you
remember,
say they diverging, they're
right?
splitting. They have a distance between one each other,
Yes, they keep
right? Because
diverging,
like
they're
yeah,
spreading.
the people that will listen won't be able to see you in your illustration. So I'm just trying to make it all clear.
I see. All right, cool. So when they
Yes.
diverge, all right, that kind of gives me an alert. You're right. It's not a timing tool. It's just giving me a bias that all right, I can see that the COT indicator has diverged quite a lot, and now I come to the chart. So I'm more of a monthly, weekly, and a daily trader. So I'm a swing trader. I'm not an intraday trader who goes on the 5 minutes, 1 minute, 15 minutes. That's not my cup of tea. So being a swing trader, you have a lot of time at your disposal. So coming back to it, so once I have observed it on the COT indicator, I come to the charts. Now at that moment, what I remember correctly, the prices were overbought. So now I understand, all right, the COT indicator, and you can either use the Dixie as a reference point because euro dollar is a big component of the Dixie, right? The dollar index. That's
Hmm.
almost, it comprises of around 26% of the entire weightage of the dollar index. So if euro dollar takes a huge chunk of the dollar index, they are plus or minus very similar. So whatever I would see on the Dixie it would be, converse. It would be the opposite on the euro dollar because it's the euro against the dollar, right? So if I was seeing the Dixie going up, it would be the opposite on the euro dollar, which I would have to, kind of connect and understand that. All right, if the dollar goes up, then the euro should be going down, right? Because that's how a forex pair works. So once I'm clear with my fundamentals, and I would go to my charts and I would see on the monthly and the weekly that prices are overbought, as in, they have been just going in one direction. That is the time where I would be like, okay, now I just have to wait patiently. Remember, trading is all about patience. You cannot be, at your fingers trying to click the mouse button and expect, to make a living or be consistent, the least. So what you have to be, you require a lot of patience in trading, especially with a person who's looking at, daily time frames for entries. It takes one entire day for the candle to close. So once, I get a clear formation on the daily, like, it could be maybe an engulfing candle or maybe a harami pattern, or it could be an, the other kind of candlestick patterns that you have. Sometimes I do go to the 4 hour, to get a little clearer, tighter entry because at the end I want a good risk to reward trade. So I would look at it from that perspective. So the moment and the price has to show you. You were asking me about fundamental, like, I mean, that's it. Are you just looking at COT report? Afiq, I want to tell you that the chart discounts everything. What I mean by that is the chart shows everything, including the news. It's the footprint of the big whales. It's the footprint of the great white sharks. The banks do a lot of manipulation, but at the end, they can only manipulate to a certain extent. They cannot keep manipulating, forever. It's the work of these big institutions, to drive prices from one price point to another
Mhm.
price point. They need to generate liquidity. And the only way they can generate liquidity is by taking you off, because like I said at the beginning, trading is a zero-sum game. If one person makes money, the other person loses money, right? So with the
Mhm.
COT report, you get a bias. All right, I might be, I'm expecting it could be happening next week or next to next week. I don't know when, but I do expect it, in the coming future. Then I come to the charts, and on the charts, when I get a reversal sign, and I'm talking about basic candlestick patterns. Yeah, I'm not. There's nothing fancy in this. Basic candlestick patterns, and all it requires is you to make sure that once it gets formed, once the candle forms and the formation takes place, you take a trade and then do your risk management, by keeping a good amount of stop loss, and then yeah, that's it. Let the trade do its thing.
Let me
And
talk.
most importantly, staying
Go.
consistent.
Let
That's the most important thing, right? Yeah.
me go back.
All right.
Not back in time, but back to break it on your answer. You have just provided a comprehensive answer, so thank you for that. About the zero sum game, all right? You told that we need liquidity. If somebody buys, somebody sells. Now, I would like to know that if you're trading with Forex, if you're losing money, somebody takes your money, right? Now, institutions, I want to clarify a point here that everybody missing out within those days. Institutions, they claim that institutions hunts for stop loss, which causes nothing than stupidity, right? This is totally not true. Institutions don't hunt for anybody's stop loss. They hunt for liquidity zones. And what liquidity zone mean? Harsh, would you like to explain what a liquidity zone mean?
Liquidity zones are basically where a majority chunk of traders have put in their stop losses, right? So, for example, if a group of people are looking for a long, so they would have stop losses below whatever point, wherever they expect to enter. So a stop loss is basically the opposite of your trade. So if you are going long, the stop loss is a short. So when
Mm-hmm.
banks and institutions, they want to generate liquidity, they have funds, no doubt about it, but they need more funds because, like I'm not sure, but I had read it somewhere that even to move a forex pair by 10 pips, you need to inject it with a liquidity of minimum 100 million.
Yeah.
for a movement of 10 pips, on any liquid pair. I'm talking of like, the liquid pairs, not the exotic pairs. So that shows that, you need a huge amounts of funds, of money, of capital to move prices. So the
Retail
banks
traders
and
don't really have this money. They don't have
exactly right.
anything close to this amount of money. Instead, you know what? I want to make a point here. I will take advantage over this stage, and I will tell. Let's take for example that you know let's say the price is right now moving between 40 to $60. Let's take an example of dollars so people will be able to understand. When you place a trade in 55.5 short and you have caught a stop loss, this is not because the institutional chased you. This is only because they wanted to reach the 60 level. They don't want it to catch up to you. You don't even catch your interest. But if you would know that they are aiming to go to the 60 to the 60 level point, and you would short there, you make a lot of money. This is liquidity. You need to really understand or identify better where the liquidity lays within the graph and go and trade there. By the way, I want to give a shout out to Andres Simitan. He got an incredible YouTube channel. Andrea, I wish that someday he'll come to the podcast.
It will.
Him with Fabio, he's an incredible order flow trader, and I really love his like series of trading. And I really suggest people to go right now to YouTube, type in Andrea Time, and start watching his order flow course. He's incredible. I like him. So Andrea, shout out. And yeah, going back to you, Harsh. Um, let's move on from the conversation with like about liquidity, and I would like to pass a little bit the microphone to my co-host Alan here. He might got some other interesting questions, so we would like to ask you about like your journey in trading and so on and so forth. So Alan, show up time.
Yes, I want to ask you, Harsh, what were the key challenges of to getting a founding account when you just started? Like the hardest things that you had to face.
All right. So,
What were the hardest things for you as a trader?
okay. So, Alan, when I got into prop trading, it's been almost a year. So, around 11 to 12 months is when I came across one of my colleagues. He was talking about, there is something called as prop trading. And I was like, okay, I'm interested to get into prop trading. And I was very clear, because I have passion for trading. So I was like, if I'm getting into prop trading, I want to make sure that I'm going for the biggest account. Because if you go for the small accounts, the $10,000 accounts, the $25,000 accounts, you kind of take it lightly, because you are like, yeah, whatever, how much am I going to pay for that? Maybe $50, maybe $60, $75 at a max. But when you go for the big accounts, it's a huge responsibility, because first and foremost, it's a huge account, and second, you have to pay also quite heavily for that. So that kind of instills, a mutual respect for trading, as well as puts a certain amount of pressure on you that yes, you cannot take it for granted. You have to be very meticulous from day one onwards. Now, certain challenges that I have felt in trading is first and foremost, when you're handling a six-figure account, your heart beats, because the position sizes are huge,
Yeah.
compared to $1,000 account. You're easily playing with around five standards, six standards on an average per trade. So the pip value you can understand. You're playing it in hundreds of dollars per pip. Secondly, you're like at the back of your head. You're kind of a little, because you have pushed yourself into you have stepped outside the comfort zone. You are now trying to take responsibility for something which can help you get better in the future and better in life and better in trading. So I started with that mindset that all right, let us go for the biggest account. It might take a little bit of more funds, but let us make it. Let's take that call. Let's commit that yeah, we can do it. That is the first important thing that anyone who gets into prop trading should be completely aware about. Now, second, you might see the fluctuations coming in where you're like, oh, dude, I mean, my heart is palpitating. I can't, really get, it's sucking out the energy out of my life, when I'm looking at charts and it's going ups and downs. And what if I hit my stop loss? What if I hit my daily drawdown? What if I blow the account? You have all these thoughts coming into your head. It's the mental chatter, it's called, the mind is called the monkey mind for a reason. What you don't want to think about is what it thinks the most. So what I have done for myself is I have laid down a very detailed trading plan. All right, per trade, I'm going to risk this much. So I would be left with, for example, 10 or 15 trades at a given duration before I can hit my daily drawdown limit. So I reverse engineer. I look at my value, I look at the portfolio that I'm handling, and I break down the steps. I reverse engineer from the big picture and I compartmentalize it to the smaller pictures. So that keeps you lightheaded. It doesn't put burden on you, it keeps you in the safe zone because you're not risking too much, like, because even on a six-figure account, if you're risking 1%, it's a four-digit number. So you can reduce it maybe to a three-digit number, cut down the risk,
Mm-hmm.
get into the flow, let the market, see what people kind of get confused or where they misjudge financial trading is that they think that, there's a lot of FOMO in people like, hey, I'm going to miss this trade, or look, I'm missing that, FOMO is just a mentality, for someone who doesn't really understand how things work out. You were born on a particular day, you're going to leave Earth on a particular time in the future. Does that mean that the Earth was not like people did not live before you, or people will not live after you've gone? It will continue, right? We just have to make sure that whatever we find, it will come again, in the future. So you don't have to hold on to the missing bus. A new bus will come in
Yeah.
again. So just believe on your strategy, focus on your risk management, make sure you have reverse engineered your trading plan and stick to it and believe in yourself. Because if you don't believe in self, no one else will, right? And
But
let
but but when do you need to let go of the strategy? If it's not working, I mean, it's not working, right?
exactly, if it's not working, you should be clear about a strategy if it's not working within the first 25 trades. So if you have,
25.
yeah, and I would even clearly and highly suggest that until and unless you're not consistent on a demo account, it doesn't make sense for you to come onto a real account anyways, because then it's just going to eat your soul, You have to be consistent on a demo account. You have to be consistent. People take this very lightly. What people do is they might trade for like 5 months, sorry, 1 month, 2 months, and they're like, all right, now I'm ready. No, you need a good amount of trade. I'm saying 25 to a minimum. Yeah, I mean, there are people out there who would say minimum 200. Because they really want to understand what is your psychology, where are you making mistake, because the bigger the sample size, the better for you, right? So the more trades you have, the more data you have, the more analysis, detailed analysis you can do for your trade plan. So 25 is a very small number, I mean, but it's my number. People might have different numbers, but that is a starting point. And if it doesn't work, then you have to improvise it. You have to see, there is not one particular trading strategy that works all the time. Everyone has to keep tweaking their strategies here and there. We have geopolitical unrest currently in around across the globe, but it wasn't there a couple of years back to this kind of extent. So what I'm trying to say, there will be abnormalities, anomalies happening in the world. But what you can do is just make sure that first you have to believe that your trading strategy works and keep tweaking it, because you have to keep tweaking it, and then you will understand that, all right, what was not working, or what should I do, to kind of mitigate a particular error or risk or mistake that I have been doing. So it's a continuous process. It's not like, okay, I made a trading plan, now I'm done for life. It never works like that.
Yeah.
Even for me, I have to keep tweaking every month here and there. So it's like the only thing constant is life is change, right? So you just have to make sure that you keep improvising and changing as per times. And yeah, that's it. Yeah.
One
Harsh,
last thing, Arsh. One last thing. I would like to have a quote before we finish the recording. One lesson, one code that sits behind your back, the back, like in the back of your brain, and really follows you a part of for each and every single day trading.
All right. So uh, I
It's
had made
pretty
a
tough.
very,
I know.
yeah, no, no, I know it. I know it. No, and the reason,
Really?
yeah, I'm quite active on social media, like in terms of my personal life. So I had shared a quote yesterday, and it's a quote that is, highly ingrained in me. And the quote says that a ship, is safe in a harbor, but that is not what ships are built for. So what it says is, you can be in your comfort zone and be happy, with your comfortable life. But if you are not willing to take risks and step out of your comfort zone into the unknown, and if you don't believe in your own, your own skills, your own you don't have that self-confidence in you, you won't be able to make it big in life. So the same thing even with prop trading. If I did not have, the passion and the commitment that yes, I want to do it, and I stepped into it, not knowing what would be the end result, whether I would pass the account or fail the account, but it did work wonders for me, and I am a living testament for that. So a boat is safe in a harbor, but that is not what boats are meant for. So yeah.
that's a good one.
Harsh, thank you very, 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 very much
We
for the
appreciate
knowledge
it.
and the incredible insight that you have just spread with us and with our audience. I believe that what you've presented about risk management and how to read the COT report and how to look at everything and about everything, we have enjoyed it. Me personally, I have enjoyed so much chatting with you, and we would like to thank you. Thank you for being here, and and yeah, thanks.
Thanks, Afiq. Thanks, Alan, for having me on the show. I mean, it's wonderful being with you guys, who are passionate and committed about,
Wonderful being with
providing
you.
information.
Absolutely. All right. Ciao.
All right,
Bye bye.
take care. Masalama. Take care. Bye bye.